Hello friends, this is Professor Amarjeet Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. This is my privilege that I am here with you to talk on innovative debt instruments. This is the series we started in the last two sessions. Today we are going to cover a few more instruments in part 3 and then in future in part 4 as well. So friends, innovative debt instrument, as the title suggests, we are going to talk about those financial instruments which are debt, which are taken in the form of debt, means when the financing of any project, any proposal or any working capital or anything for that matter is been done through any loan, through any debt, and there is something unique. It's not a very simple straight debt instrument where we just have a fixed interest rate, fixed maturity date, etc. So that would be a normal debt. But if we have some kind of flexibility, some kind of uniqueness in payment, in maturity, in interest rate, in anything, so that would be known as innovative debt instrument. Debt instrument is always a promise to pay by the borrower, which is a company here in this in this case. So it means when a firm or a company promises to pay a loan or the debt they borrow from the lenders or from the investors, then for that matter, it is going to be debt instrument. But if there is some innovation in designing that instrument, it would be innovative debt instrument. So we have talked about couple of debt instruments in the past, be it zero interest bond or zero coupon rate, zero special premium notes, SPNs, etc., etc. So we have discussed couple of debt instruments in the past. Today we are going to talk about few more debt instruments. Primarily I would be talking about market linked debentures and green bonds. To begin with, I will be talking about market linked debentures, MLDs. So in the past we have talked about zero interest bond, deep discount bonds, secured premium notes, floating rate bonds, FRBs, callable bonds and debentures. These has been discussed, and today we are going to begin with market linked debentures. So what are market linked debentures? Hybrid debt products known as market linked debentures provide return that are correlated with the performance of an underlying asset, security or market index. They blend the development potential of market linked investment along with the conventional bonds which offer a fixed income. So let me explain it to you. So as the name suggests, it is a debt instrument, a debenture primarily, which is linked to some other asset. That some other asset could be anything. I will discuss in detail in few minutes, but it is linked to some other financial asset. So it could be treasury bond, it could be RBI bonds, it could be gold price, it could be equity price, so that the value of this particular instrument, that is debt instrument, is actually affected by or decided by that underlying asset or security, right? It could be a market indexed, very simple. So it is a hybrid product because it has features of fixed income as a debenture would have, as a bond would have, a percent, an explicit rate of interest, along with certain percentage of return which is linked to market security. So that is why we call it as market linked debentures. So they provide return which is correlated with the performance of some other asset. It means some other asset's performance, how that market index, how gold price, how treasury bills price are doing in the market. That will decide the returns on this investment, which is MLDs, market linked debentures. So they actually blend the both development potential of the market linked investment along with a conventional bond where we have a fixed income. right. So, you are sure that you have a certain returns for sure as a rate of interest. Of course, that rate of interest would be slightly lesser than what any normal bond would offer, any normal bond debenture would offer, right, any conventional bond or conventional debenture would offer. But here you have a if you as an investor foresee that in future the market is going to give a very good return, but you are not very confident to take that much risk to invest purely into market, be it equity. So, what can you do? You can actually go for MLDs where you are getting certain rate of interest as a fixed one, and then you are also getting some advantage or rather good advantage of market growth as well. So, that is what the market linked debentures are. So, MLDs are issued by corporations and financial institutions to raise capital from interested investor, usually at a face value of 10 lakhs or even 1 crore for times. The specific payout structure is defined in the offer document or instrument and varies depending on the MLDs. So, these MLDs, the market linked debentures, are issued by whom? By companies, by corporates, firms, right, and also by financial institutions. Banks will issue, even RBI can issue for example, or any SIDBI and FICCI, a couple of more financial institutions, they can issue, they can raise capital through MLDs. From whom? From the people who are ready to invest, right. It goes like an open offer in the market, and generally the face value of one MLD is higher. For example, in equity share the price is 10 rupees or 100 at the most. Most of the equity shares are issued at 10 rupees each, but MLDs are not like that. MLDs have, one MLD is generally is of 10 lakhs rupees. So, they are highly valued as one instrument is highly priced. Okay. So, and they would always have a specific predefined very precise schedule of structure of payment, how the payment would be made at maturity. Exactly everything is defined in the document, in the instrument, on the face of it, and it varies depending on what kind of MLDs has been issued and who has issued that MLD. So, even the same company would have different payout structure basis on the need, because somebody is raising capital funds, right, because to meet up the to meet up the requirement of any project or proposal or expansion or modification, we are going for raising capital through MLDs. That is why we are raising. So, if we are raising capital or funds, we would decide the payout structure as a company basis on my need. Some project may have life of 5 years, some may have 20 years, some company may have shorter duration requirement, another may have very long duration or mid duration, right. So, the payout would vary. The market linked debentures are basically, they are fixed income structure products that give no periodic coupon, but pay only at maturity. Thus, MLDs can be stated simply as debt securities where the return on investment totally depends upon the market index performance. So, here though we may have we may know that this is the assured income, but there is no coupon rate, there is no periodic 6 monthly interest is being paid. The total amount is paid back on maturity only, whatever has been designed or whatever has been structured. So, it is a fixed income structured product. Income to certain extent is fixed, remaining is linked to the market security, any security, and they are MLDs can be stated simply as a debt security, which actually assures a return on investment depending upon any market index performance or any security performance, generally to index. Now, these market linked debentures can be of two types. The first type is principal protected MLDs and second type is non-principal protected MLDs. So, the principal protected MLDs, the guarantee of payment of full investment principal of the maturity at the time of maturity. The second, non-principal protected MLDs, investor's principal is not guaranteed and is subject to market risk. So, as I said, MLDs can be designed as per need, as per requirement, as per risk involved, as per demand of the project, as per the country conditions, economic conditions, geographical conditions. So many factors play a role in designing an MLDs, especially a company's requirement, firm's requirement. So, the ones, those MLDs which are protected for the principal to be paid for sure, they guarantee of full payment of principal money which has been invested by an investor. So, it means there is a slightly less risk in these MLDs than the ones which are non-principal protected MLDs, where the investor's principal is not guaranteed and is subject to complete market risk. Means it will depend upon that how that market index or underlying security is behaving. If underlying security has gone in negative, right, there is no growth and at the time of maturity, you may not get even the principal money. So, there is no guarantee. You may get partial 10%, 20%, 30% depending upon how the underlying security is behaving or doing or performing in the market, right. So, accordingly the more the risk is, the higher the return is expected, right, that is what it means. So, in the non-principal protected MLDs are certainly more riskier than the ones which are protected. Of course, that goes without saying. It means in that case the expectation of investor would be higher. So, they would be more expensive as well. So, issuing non-principal protected MLDs becomes an expensive affair for a corporation, but companies who do not have any security to assure payment, or companies who have really no guarantee of cash flows, they may like to issue it at a higher return by promising a higher return for them if they are able to make it till the maturity. So, this is an example of market linked debenture. For example, ABC company issues MLDs at the rate of 12% per annum coupon maturing in 24 months. The coupon is paid only on the condition that the Nifty index does not fall more than 25%. If the index falls more than 25%, then only the principal is returned, no interest is paid. This is an example of principal protected MLDs, right. So, designing of MLDs varies from company to company. Here I am assuming a company named ABDC or ABC, right. They issues MLDs at the rate of 12% per annum coupon. So, maturing in 24 months. So, after 2 years they would be paid back along with a coupon rate of 12%. Now, coupon is payable only, so this is conditional. The coupon would be paid only if the Nifty does not fall more than 25%, whatever the rate value of Nifty index was at the time of issue. It says, like, let us say if it was 100, no, I am just saying it is not. So, if does not fall less than 25 means it is not below 75 rupees, then the index will be, then the coupon interest would be paid. If it falls below 75, it will not be paid. So, index fails to perform then more than 25%, then only the principal is returned, no interest is paid. So, this could be designed either way, the percentage could be different, duration could be different, the index underlying security could be different. So, this was just an example. So, there are a couple of companies in India who have issued such MLDs. For example, Sri Ram Finance, they have issued, their price was 1 crore, the coupon was 0%, rating was AA plus, and yield was 11.5%. There is another company UGRO Capital, they issued 10 lakh worth of MLDs, coupon was of course 0%, rating was A only, not AA plus, and the yield was 10%. So, expected yield was 10%, it was less than the Sri Ram. Another example, which is in real estate, another company at Wells. So their price was 1 lakh, coupon was 0%, rating was A, yield was 10.4%, right. That is how the, these are the real examples of companies who have offered, issued market linked debentures. Now we would study how market linked debentures work. So first of all, the market linked returns. Underlying benchmarks such as Nifty 50, a government security yield, gold price, or a currency exchange rate even are linked with the as are connected or taken as underlying asset. And one time payout, principal along with the market linked returns as a single lump sum payment upon the MLD's maturity is paid. So one time payment is there, it's not the coupon is paid. In a normal bond or debenture, coupon rate is paid every 6 months, right, annual. So but here it is a one time total principal along with the market linked returns as they are paid as a lump sum. So at the time of maturity, maturity could be anything, 2 years or 5 years or 10 years. Okay. So the first working condition is that they are linked to market linked returns. They are linked to either Nifty 50, gold price, currency exchange price, any particular currency, be it dollars, be it yen, any currency they can link to that, and the one time payment. These are two things. Another thing, points regarding the working of MLDs are the principal protection. Many MLDs are structured with a capital protection feature, granting the return of the principal amount of maturity. Fixed tenure ranging from 1 to 5 years generally. Credit rating agencies rate MLDs, which indicates the credit worthiness and the risk of the default. So as we said, we talked about that they are always linked to some market security, the underlying asset. Then the maturity amount is paid only at once. It's not regular or frequent earning security as any normal debenture. Another point is that the principal could be protected if they are principal protected MLDs. There could be non-principal protected as we discussed in the type. So that is another possibility. Maturity generally ranges from 1 year to 5 years. We took few examples, Sriram, Arago Limited, etc. They have generally 2 years, 3 years life. So because it's not very long duration, because investor is paying off something and is not getting anything during the life of the instrument. He or she is getting only at the time of maturity, be it principal or be it even the yield, the returns. Okay, the rating is to be done for sure. MLDs can be issued only when the credit worthiness of a issuer is established by the rating agencies, A plus minimum, and that credit rating also indicates how much is the risk. For example, 3 example or 4 example I just shared a few minutes ago. One security has AA plus, another has only A, another third one has AA, right. So they all the 3 have a different risk potentials, right. So the rating is being done. This is how these market linked debentures work. So now times come that I talk about merits and demerits of MLDs. So let us talk about merits first. Potentials for high return, that is the first one. The second one is capital protection. Third one is diversification, and fourth one is customization. These are the merits. So first merit is potential for high return, because your returns are linked with the market, and if you are fortunate enough, if you are an investor with a good luck in your side, then if the market is doing very well, you will get certainly a very high rate, a very high yield on your MLDs. So there is a potential, there is no guarantee. If there is no principal protection, you may end up losing your even the principal money. But nevertheless, if markets or the economies are doing well, because people who invest in MLDs are well versed with the market conditions. It's not, and generally investors of retailers generally do not end up buying MLDs. Okay, so people who have a good sense of market, have a good ability to project how the market is going to behave, are the ones who are potential investors in MLDs. So, this is the first thing, that MLD has very high potential of high returns. The second merit, as I said, is capital protection. If because you have a choice to as an investor to invest in a market linked debentures where capital is protected, and another one where the capital is not protected. So, capital protection and non protection, right. So, capital protection is where we have even the principal money is protected. So, that is a merit, that you are taking risk of in earning high, though if the market behaves well, but nevertheless you have a high risk as well. But if you choose to invest only in capital protected MLDs, then at least your capital is protected. So, the people who have plenty money available, plenty of money available for investment are the ones who would be investing here. Then diversification is possible, naturally it happens, because if your security is linked to certain market index, let us say Nifty would have already in Nifty 50, the 50 companies, that is an index of 50 companies and of almost all size, large size, mid size, small size companies are there. So, automatically your portfolio is so well diversified. You need not to diversify, you need not to invest individually in large cap or mid cap or small cap companies. Your portfolio is such because performance is linked to Nifty, for example, or some other index. So, it's automatically gets diversified. Then the fourth point, as I said, is customization. Because companies do design their MLDs as per needs. So, investors get benefit of that. Nevertheless, even companies are free to customize as per the need of the project or the company or the business situation in that during that time. So, time duration, payment structure, everything can be customized. There is so much flexibility here, right. So, MLDs can be customized by companies basis on their need, basis on the length of the project, basis on the risk in the market, because ultimate purpose is to be able to sell those MLDs, right. So, company will be able to sell only if they are very careful about curating those MLDs. So, MLDs are curated like like a flower pot, or a planter is being curated by good curators, uh, you know good gardeners, good people with good taste. So, same way these MLDs are curated by companies basis on their need. The last part I want to talk about is demerits of MLDs. There are a couple of demerits. The first one is market risk, the second is credit and liquidity risk, the third is complexity, the fourth is taxed as short term gains. So, these are the primarily or major demerits of MLDs or disadvantages of MLDs. The first one is they are linked to market risk. If the market is not performing well and somebody has invested even in non-protected, non-principal protected MLDs, you can imagine the fate of the investor. The person will actually lose his or her even the principal money. That could be the worst investment possible. So, there is a so much high market risk, because it all depends on the knowledge, experience, calculations. It is a calculative investment of the investor. So, how the market behaves, that affects the MLD's performance as well. The second is credit and liquidity risk. There is a risk of credit, there is a risk of liquidity as well. Liquidity risk means possibility of not being getting the money, not being able to sell them in the market, or not being getting the money when there is a need. So, investor may not be able to sell MLDs in the open market so easily, because there are not many buyer in the secondary market. So, it is not easy to, shares can be traded so confidently, comfortably in the market. They are very much like liquid assets, liquid financial instruments, but not MLDs. MLDs have a huge, big amount. Most of the MLDs, as I said, are for 10 lakhs. Most of them. It's not, we do have examples of 1 lakh each as well. So, it's not easy to sell them off in the open market. So, there is a liquidity risk. And then MLDs are very complex. It's not that everybody can understand how the MLDs work, what kind of instrument they are, because every MLD is structured independently. You need to have the knowledge of debt market, you need to have the knowledge and understanding of the underlying asset, and that underlying asset or index may vary from one MLD to another. So, MLDs are peculiar to the need, peculiar to the market, peculiar to the company situation or the geographical situation. So, MLDs are very complex. Everybody cannot comprehend MLDs. That is why there are not many takers. Only seasoned investors with good background, financial background, would like to invest in MLDs. And the last point is that the return on MLDs, that is the gain, is treated as short term, and short term gains have a high tax rate, we understand. The long term capital gain has a lesser tax percentage, whereas the short term capital gain has a long or higher tax rate. So, they are, because generally they are short term, so they are taxed at a higher rate. So, these are the limitations of MLDs. I hope you were able to understand what MLDs are, how they function, what types of MLDs we do have, and what are the advantages and limitations of MLDs. So, with this I would like to now wind up, friends. Thank you very much.